Welcome to our CFP Exam Prep podcast. Today, we're diving deep into a critical tax concept that often appears on the exam. Section 121 exclusion post 2009 non qualified use rules can trip up even experienced professionals. Let's break down the core concept. Section 121 allows homeowners to exclude up to $250,000 of gain from the sale of their primary residence, or $500,000 for married couples filing jointly. However, the rules regarding non-qualified use periods significantly impact this exclusion, especially for properties acquired after 2008. Here's what you need to understand. Non-qualified use refers to any period when the property is not used as the taxpayer's principal residence. The key point that many candidates miss is that appreciation during non-qualified use periods after 2008 cannot be excluded under Section 121. This is a fundamental shift from previous rules. Let me walk you through a practical example. Imagine Sarah purchases a house in 2010 for $300,000. She rents it out for 3 years, then moves in and uses it as her primary residence for 3 years before selling it for $600,000. Many candidates mistakenly assume she can exclude the entire gain under Section 121 because she met the 2 out of 5 years residency requirement. This is incorrect. The appreciation must be allocated between qualified and non-qualified use periods. If the property appreciated by $150,000 during the rental period and $150,000 during the residence period, only the $150,000 appreciation during the qualified use period would be eligible for exclusion. A common trap on the exam involves temporary absences. The IRS treats certain temporary absences due to health conditions, job changes, or military service as qualified use periods. Don't fall for questions that try to categorize these legitimate absences as non-qualified use. Another crucial detail is the ordering rule. Non-qualified use periods before the last use as a principal residence don't count against the exclusion. However, any non-qualified use after the last period of principal residence use will affect the exclusion calculation. When tackling exam questions on this topic, follow these steps. First, identify if the property was acquired after 2008. Next, determine all periods of non-qualified use. Then, calculate the appreciation during each period. Finally, apply the exclusion only to appreciation during qualified use periods. Remember these key exceptions. Periods of non-qualified use do not include any period before January 1, 2009. Time spent in qualified extended duty military service doesn't count as non-qualified use. Also, any period after the last use as a principal residence is always considered non-qualified use. A major mistake students make is confusing the 2 out of 5 years ownership and use test with non-qualified use rules. These are separate requirements. You can meet the 2 out of 5 years test, but still have gains that can't be excluded due to non-qualified use. The best way to master this concept is to practice with various scenarios. Focus on timing, property appreciation allocation, and proper classification of use periods. When you see Section 121 questions on the exam, take a moment to identify whether non-qualified use rules apply before jumping to conclusions about gain exclusion eligibility. This technical detail often appears in exam questions because it tests multiple concepts simultaneously. Understanding these rules thoroughly will help you navigate both the CFP exam and real-world client situations effectively.